Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. So thankful you gave us a few minutes of your time here at the first Market Carver of December, believe it or not. Hope everyone had a truly great Thanksgiving, especially after all that we've been through over the past year. And maybe it was, for many of you, the opportunity for the first time in a couple of years to see some of your family. So, but here we are on to December already, and we've got a packed agenda here today. Several topics. We're going to hit some real estate, inflation, a topic that just doesn't seem to want to go away. And then, as always, some underneath technical indicators and taking an updated look at where we are, especially after we've seen a little bit of correction in the market. But we're going to start off with some real estate points, something we really want to keep an eye on. For opportunity. We are interested in all aspects. We're not just stock and bond, but real estate, of course, has very important implications and from time to time opportunity. So student housing is one of those that we've paid a lot of attention to over the last several years. And as we look at the updated occupancy after the students are back in school for the fall, we have 93.7% occupancy. Now, the reason that's interesting is that we were at 92.3% pre-pandemic. So that kind of sets up the comparisons that we want to look at. Now, we had a really challenging year last year. We want to see how do things look now versus where we were before the pandemic to give us a real picture on where we stand today. And in that market, we actually have a very healthy and robust set of demand for the available student housing. When we say student housing, what we're talking about are, of course, apartments built near campus that are built for students but aren't necessarily attached to the university. So a very healthy area of the market right now. And of course, had a challenging year last year with a lot of students at home studying. I think the occupancy was in the mid 80s somewhere last year, which isn't devastating. It doesn't bankrupt buildings, but it's certainly not profitable. 93.7 keeps it a pretty tight market. One of the most concerning areas, of course, besides retail, has been office, with all the question marks about how and when people will return to office work and to what extent it will look like it was before. More than maybe any other sector in the real estate market, location matters a lot. Manhattan, very different from Connecticut. And so as this whole piece is put back together, we're going to look at it from a national level, then we break it down from there. This one kind of caught my eye and actually by surprise a little bit because it seemed healthier than I thought it might be. So this was as of late August. Office space across the United States was just 13% below the pre-pandemic level. So I was quite impressed by that number. There's been a lot of steering away from office real estate, so I'm not going to say it's a screaming buy. But the fact that it's just 13% pre-pandemic certainly has an eye open, particularly for advantageous to really healthy areas of the United States. So a couple of things in the real estate market that have our attention. Moving now to inflation, but of the United Kingdom. All right, so we're used to talking about inflation from a United States perspective because a lot of it has to do with the dollar, and we think about what we've done from a policy perspective and how that may or may not have created inflation. One dynamic that we just can't get away from is the fact that inflation, as of today, is truly absolutely a global phenomenon. We've got a lot of similarities to the UK, demographically, the composition of our economy, but there's been some differences. The way we've approached the pandemic has had some differences. They haven't had near the fiscal response, both in terms of the support payments that went out last year and the larger bills this year, and they also haven't had the monetary response in terms of the aggressive central bank action. And in fact, the UK has been much more hawkish, which means leaning towards interest rate increases. So those are all the examples that is pointed to in the United States here for being inflationary. But if we look at the UK, this is a chart of their inflation, and they're actually at 6%, which is right around where we are at this point in time. So the point there, again, kind of ties back into the thirdly. If you had the opportunity to join us, part of my message there was just how complicated the inflation story is. And I think this is just one more angle of it, you have these similarities in economies, different responses, but very similar inflation. It is truly a global phenomenon, and we've got a lot to unpack as we move forward on that topic, as does, of course, the Federal Reserve. And everything about this inflation for us in terms of what it means to you is how that Federal Reserve will ultimately react. Moving back to a point we made last week in the damage in the Nasdaq 100 that is underneath the hood. So the Nasdaq 100 is of course 100 stocks, and then the chart of that index, which is just like the S&P 500 in terms of the biggest companies like Apple, have the biggest weight. It is still very close to its all-time high. The chart has been moving up and to the right in a very healthy uptrend. Meanwhile, over the last several weeks, we've seen a lot of those stocks. And that was the point last week, but a lot of stocks that are really far down, 50, 60, in some cases 70% down. The middle panel, this was put together by Andrew Thrasher, of course, our chartered market technician. The panel in the middle shows you the average drawdown. How far is the average stock? So if you look at the chart on the top, the index is very near its all-time high, just down a few percent. But the average of those 100 stocks is now down substantially for the year, well into the double digits by now. The bottom panel measures the difference of the drawdown between the index and the drawdown from the average stocks. And we're at levels that are quite stretched, meaning that there is a wide spread between what we have in the index, the Nasdaq 100, and then those 100 stocks. In fact, you have to go all the way back to the dot-com craze in the late 90s to find an index that or find a scenario that was that stretched, where you had just a few stocks that had driven that index to substantial highs while there was damage underneath the market. That doesn't mean that this is going to follow suit, that the index will crash down to the levels of these individual stocks. It certainly is something that has our attention. It could also mean that there's a lot of opportunity in those stocks. So now, in terms of what your investment team is monitoring day to day, the conversations Andrew and I have will be to what extent we have to be protective against the index versus looking for individual pieces to pick up. And that is commanding our conversations day in, day out. Amongst those Nasdaq 100 stocks, the hedge fund, we have called a lot of them hedge fund hotels, meaning they are camped out in those stocks. This is a look at hedge fund allocations going back to 2002 and their allocation to high growth stocks, which the Nasdaq 100 is heavily weighted in. So the top, the gray, is the percentage in stocks that have greater than a 10 times multiple. So in this case, we're used to using price to earnings ratio. This would be similar to it. It's enterprise value, which is the value of the stock of the company plus the value of its debt relative to its sales. So the higher the number, in this case greater than 10, means the more stretched, the more expensive that stock is. And then the blue is greater than 20 times. So in both cases, you're looking at growth stocks and the weighting in hedge funds, and they have just absolutely taken off. So that group of stocks, those that have high valuations and are expensive, have done very, very well. As a response, hedge funds became very concentrated in those stocks. So several of them, and again, not all hedge funds are alike, but several of them are going to have quite a bit of damage to unravel from the weeks of decline in those Nasdaq 100 stocks that they are heavily concentrated in, as indicated by this chart. So that is another thing that certainly has our attention, the reaction of those hedge funds, or in some days we used to have them as part of the big boats. And then lastly is the market health report. This is another piece put together by Andrew Thrasher. This is a custom-made index of a variety of indicators he put together, and he reviews it every time the index, the S&P 500, retreats to a new 15-day low. At that point in time, we have just what would be a mild correction. We look underneath that at those indicators and are looking what the underlying health is as we add up all of those indicators. And what he's looking for are instances where there is a -5 reading in that indicator. That is the bottom panel. You can see it plotted out. We actually had an instance back in September where the market was in a worse state than it is now. So we have seen another 15-day low in the market. But at this point in time, there is a +5 reading in his market health report. So a good 10 indicators away from that -5 reading that would cause us to be a little bit more concerned. Doesn't mean it won't turn into that. But as a status for now, we have reason to believe that this is a pullback and a correction in an otherwise healthy market environment. And we certainly hope that remains true. Please don't hesitate to give us a call to schedule your meeting or scan this QR code. And don't forget that you have a chance to listen to the radio show, whether it's on the actual radio or in a more convenient podcast form. Thank you again for your time, and have a great weekend.